Follow this thought. It's Sunday evening. Someone, let's say they just retired. They've got a little over $1 million sitting in a brokerage account. They did everything right, saved for decades, stayed invested, didn't panic, and now they sit down to figure out, okay, how do I actually turn this into income? So they do what most people do. They Google it, Best Dividend ETFs 2026, and they get 47 results, all slightly different. Some say high yield is the answer, some say dividend growth, some say covered calls, some say bonds, some say all of the above. An hour later, they close the laptop, more confused than when they started. The screen is glowing, their eyes are tired, and that $1 million, the result of 30 years of hard work, is just sitting there like a dead engine. Still not producing anything, still just a number. And that's a surprisingly lonely feeling. You spent 30 years learning how to build wealth and almost no time learning how to live from it. Retirement was supposed to bring clarity. Instead, it brought another decision. And here's what I've noticed about that moment. The problem isn't that there are too many options. The problem is that they're asking the wrong question. Which ETF is best is not the question. What job do I need this money to do? That's the question. And once you ask that instead, everything changes. My name is Nick, and I spend a probably unhealthy amount of time thinking about money. Not in a here are the top 5 ETFs to buy right now kind of way. More in a why do people with genuinely good portfolios still feel like the income part is impossible to figure out kind of way. Because here's what I keep seeing. People spend 20, 30 years building the machine, and then they get to retirement and realize nobody ever taught them how to run it, how to actually extract income from it without breaking it. In the last episode, we talked about why retirees who never sell shares end up with more. Today, I want to show you what they do instead. Practically, specifically, the 3-job framework. That's what this episode is about. Okay, so let's start with the mistake most people make. When most people think about retirement income, they think about it as one thing, one pot, one portfolio, one question: how much can I take out each month? And that framing, that single pot framing, is exactly what gets them into trouble. Because not all retirement money is doing the same job. Some of them need to be available immediately, this week, this month, completely safe. Some of them need to produce reliable income over the next 10 years. And some of it needs to keep growing for 20 or 30 years, so the portfolio doesn't slowly die. Those are 3 completely different jobs, with 3 completely different requirements. And if you mix them up, if you use long-term growth money to cover short-term bills, or if you put your safety money into high-yield income funds, chasing returns, that's where things go quietly wrong. The retirees who get this right don't have better ETFs. They have better job descriptions. They stopped asking, how much money do I have, and started asking, what is each dollar responsible for? Let me show you what I mean. So, the framework. Take whatever your total retirement portfolio is. Let's use a round number, $1 million. The framework applies regardless of the actual amount. The proportions are what matter. Job 1. Stability. Roughly 8 to 10% of the portfolio. This money has one job. Be there, completely safe. No growth is required. No yield is required. Just available. On $1 million portfolio, that's about $80,000 to $100,000. Sitting in a high-yield savings account or short-term government bonds. Not invested. Not growing in any meaningful way. Just sitting there. Why? Because this is what you live from when the market is having a bad year, when everything else is down 25 or 30%. You don't touch any of it. You live from this bucket, for 1 year, maybe 2, while the market does whatever it does. This bucket doesn't make you richer, it keeps you from becoming poorer at exactly the wrong moment. And that kind of calm is worth far more than most people realize. Job 1 isn't an investment, it's an insurance policy against your own panic. Job 2. Income. Once you've protected your future decisions, now you can build your retirement paycheck. Roughly 35 to 40% of the portfolio. This is the part that actually replaces your paycheck. And this is where most people get confused, because income sounds simple, but there are 2 very different ways to do it. The first way is dividend growth. You buy funds holding high-quality companies with a long track record of paying and increasing their dividends every year. The current yield isn't enormous, maybe 3 to 4%, but that yield grows over time. 5 years in, the income is higher than when you started. 10 years in, it's meaningfully higher. The income keeps pace with inflation without you having to do anything. Think of it like a tenant who pays rent and gives you a small raise every single year without you having to ask. The second way is higher current yield. Covered call funds, preferred share funds, and international income funds. These pay more right now, sometimes 6, 7, 8%. But they give up some upsides in strong bull markets. The price growth is slower. Neither one is better. They do different things, which is why the retirees who build this properly usually blend the two. On $1 million portfolio, $350,000 to $400,000 in a blend of dividend growth and higher yield income funds. At an average yield of say 5%, that's $17,500 to $20,000 a year landing automatically, every quarter, sometimes every month, without selling a single share. That income refills job one over time. You're not draining the safety bucket permanently, you're just using it as a buffer while the income keeps flowing. Job 3, growth. The remaining 50 to 55% of the portfolio. This is the machine from episodes 1 and 2. Total market index, broad diversification, hibernation mode. You haven't touched this for a decade. Its job is one thing: beat inflation over the long run. Keep the overall portfolio growing so that in 15-20 years the income layer is still producing real purchasing power and not being quietly eroded by rising prices. On $1 million portfolio, $550,000 in the growth engine, left completely alone, not checked every week, not adjusted every time the market sneezes, just running. 3 jobs, 3 buckets, 1 system that produces income, provides safety, and keeps growing, all at the same time, without you having to sell anything. Now, I want to stop here for a second, because I can already hear the question forming. Nick, this sounds reasonable, but which specific funds, which dividend ETFs are, what exactly goes on job 2? Yay, that's the right question, and I'm going to get there. But before I do, there's a trap that catches almost everyone who builds this framework, and it's not about the wrong fund, it's about the wrong number. A yield number specifically, and if you fall for it, it quietly breaks the income layer within 5 years. The trap is called yield chasing, and it's one of the most natural mistakes a person can make. Here's how it happens. You're building your job 2 income layer. You look at 2 funds. Fund A yields 3.5%. Fund B yields 8%. On a $400,000 income layer, Fund A gives you $14,000 a year. Fund B gives you $32,000 a year. Math seems obvious. Fund B, more income, done. But here's what that number doesn't tell you. High yield almost always comes with a trade-off. The fund is paying more than it's actually earning, which means it's slowly returning your own capital to you, not generating real income. Or it's taking significantly more risk to generate that yield, more volatile, more exposed to credit events, more likely to cut distributions in a bad market. Fund A, 3.5% yield, might be a fund whose underlying companies grow their dividends by 7 or 8% a year. So, in year 1, you get $14,000. But in year 10, because the dividends kept growing, you're getting $26,000 from the same initial investment. The income grew. The principal grew up. Inflation is beaten. Fund B, 8% yield, might look like $32,000 in year 1. But if the price slowly erodes over time because the fund can't sustain that payout, you're actually poorer in year 10 than you were in year 1. The income stayed flat or fell. The capital shrank. You're not living on the golden eggs anymore. You're slowly eating the goose. And in a 30-year retirement, that goose will run out long before you do. More yield today is not the same as more income over a 35-year retirement. Income that disappears isn't income, it's just a temporary illusion. The retirees who get this right are not chasing the highest number on the screen. They're asking, will this income still be here in 20 years? Will it be higher than it is today? Because Rick Edelman has been saying for years, we are the first generation likely to live past 90, some of us past 100. If you retire at 65 and live to 95, your job 2 income layer needs to work for 30 years, not just look good on a spreadsheet today. Rick Edelman's argument fundamentally changes how you think about yield. The old retirement model, the 60/40 portfolio, the 4% withdrawal rule, was designed for a 15 to 20-year retirement. That math hasn't survived for 30 or 35 years. But a dividend growth approach, where the income itself grows over time, has a fighting chance, because it's not fighting a static battle, it's compounding income, not just compounding capital. Alright, so practically, how does someone actually build job 2? The retirees who do this well, and I mean the ones who genuinely sleep at night, not the ones who check the portfolio 3 times a day, they keep it simple, deliberately simple, not because they're lazy. Because complexity in retirement creates decision points, and every decision point is an opportunity to make a fear-based choice at the worst possible time. The typical well-built income layer has 2 components, not 15. 2. Component 1, a dividend growth fund, the foundation. This is a broad fund holding high-quality companies with consistent dividend growth histories. The yield today is modest, 3 to 4%. But these companies have raised their dividends every single year for 15, 20, sometimes 30 years, through recessions, through crashes, through everything. The income from this component in year 1 is not exciting, but in year 15, because of that consistent growth, it's substantially higher than what you started with. This is the tenant who gives you a raise every year. Component 2, a higher income fund, the cash flow booster. This is where you get more current income. Covered call strategies, preferred shares, or international dividend funds. Higher yield, 6 to 7%. Less price appreciation. More cash is arriving now. The trade-off is deliberate. You're accepting slower capital growth in exchange for more income today. That's a reasonable trade for someone who needs their job 1 bucket refilled consistently. The blend between these two, depends on what you actually need. If your living expenses are modest and job 1 is comfortable, you lean more into dividend growth. If you need more income right now, you will increase the higher yield component. But you don't need to get this perfect on day 1. Think of it like adjusting the thermostat in your house. Small changes over time, not rebuilding the house every season. Because this is a system, you can adjust the blend slowly over time as your situation changes. Rick Ferri, who spent decades managing portfolios and has been one of the clearest voices on passive investing, has a principle that fits here exactly. Simplicity, automation, hibernation, 3 words. In the income phase, this means a simple blend of 2 components, automatic quarterly distributions, and then leave it alone. The people who tinker with the income layer constantly, moving in and out based on yield changes, rebalancing every month, almost always underperform the people who built it simply and walked away. Not because they're smarter, because they removed themselves from the equation. The market is a noise machine. Your architecture is noise-canceling headphones. The simpler the system, the quieter the retirement. I want to take a minute here because I think there's something underneath all of this that's worth naming directly. For most of your working life, the skill was saving, discipline, restraint. Don't spend it. Automate. Stay in. The skill was saying no to your present self on behalf of your future self. And that skill worked. It got you here. But in retirement, the skill changes. And this is the part that catches a lot of people off guard. In retirement, the skill is architecture. Designing a system that produces income reliably without requiring you to make constant decisions, without requiring discipline every month, without requiring you to fight your instincts every time the market does something alarming. Because here's the thing about discipline. It's exhausting over a 35-year retirement. You can't white-knuckle your way through 3.5 decades of monthly income decisions. Eventually something gets to you. A bad market, a health scare, a moment of tiredness. The 3-job framework removes the monthly decision. The income arrives. The buffer absorbs the gaps. The growth engine runs. You check it quarterly. That's it. You're not managing money anymore. You're supervising a system. Good architecture quietly replaces daily willpower. And that shift from manager to supervisor is honestly one of the most underrated things wealthy retirees do quietly that most people never notice. So, back to that Sunday evening. Someone, $1 million. Google is open. 47 results, all contradicting each other. Imagine they closed the laptop, opened a notebook instead, and wrote 3 questions. What money needs to be completely safe, right now, this year? What money needs to produce reliable income for the next 30 years? What money needs to keep growing so the whole thing doesn't slowly lose to inflation? 3 questions, 3 jobs, 3 buckets. Not 47 ETFs, not a complicated formula, not a spreadsheet that requires a finance degree to understand. Just, what job does this money need to do? The answer to that question tells you everything about where it should go, and once each bucket knows its job, the system runs, the income arrives. Safety holds, the growth compounds. You stop managing money and start living on it. Which, if you think about it, is the whole point of everything we've been building across these 5 episodes. The machine was never supposed to be something you watch. It was supposed to be something that runs while you live. Because after 30 or 40 years of working for your money, retirement should be the season where your money finally starts working quietly for you. The goal was never to become a full-time portfolio manager at age 65. The goal was to finally stop being a manager altogether. So, the same question I always ask, and I do read these. When you think about your retirement income, are you still looking for the best ETF, or have you started thinking about the job each part of your money needs to do? Drop it in the comments. Because those are genuinely 2 different places to be, and knowing which one you're in changes what you should be focused on right now. And if this series has been useful, subscribe, because the next episode is going to go somewhere we haven't been in this series. We've talked about building the machine, protecting it, and running it. Next time, we're going to talk about the one retirement risk that has nothing to do with the stock market, yet quietly destroys more retirement plans than market crashes ever do. Not by a market crash, by something quieter and more personally. That one is going to land differently. See you there.